Question 7 in homework 4 of the MyOpen Math macroeconomic problem set models crisis mode. With a demand curve given by the federal funds rate equal to 5 minus 0.05 times the total quantity of reserves in the banking system gives the downward sloping demand curve labeled RD. In my particular problem, the quantity of reserves supplied is assumed to be $96.096 billion. That's the vertical section of the kinked reserve supply curve labeled RS. In my problem, the Fed sets its target for the federal funds rate equal to 0.2. Given the Fed's penalty discount rate policy implemented in January 2003, the discount rate must be 1.2%, the flat section of reserve supply. The demand curve crosses the vertical section of supply at the federal funds rate equal to 0.20. Thus, the equilibrium federal funds rate equals the target. The federal funds market is in normal mode in the scenario depicted in this slide. In late November 2008, the Federal Reserve started buying $600 billion in mortgage-backed securities. If we assume the Fed purchased 23% of these from banks by the end of the first week of December, the size of such a purchase would be $138 billion. This purchase increases the quantity of reserves supplied in the federal funds market by $138 billion. The increase in reserves is depicted by the shift in reserve supply from the kink black curve to the kink red curve. The result of the massive mortgage-backed security purchase of $138 billion would reduce the equilibrium federal funds rate from 0.2% to negative 6.7%. Because the federal funds rate target is still set at 0.2%, the equilibrium federal funds rate is not only negative, but it's well below the Fed's target. In this situation, banks needing to borrow reserves would get a loan from other banks with excess reserves at a negative interest rate of 6.70. So the banks that do the borrowing would have their interest payments paid for by the banks making the loans. The Emergency Economic Stabilization Act of 2008 moved the implementation date of the Fed being able to pay banks interest on reserves to October 1st of 2008. In our problem, we're going to assume the Fed has set this interest rate at 0.2%, which is depicted by the blue line segment in the graph on this slide. Because banks would rather lend their excess reserves to the Fed at this rate rather than to other banks at the negative federal funds rate equilibrium, interest on reserves kinks the reserves demand curve, which is now all in blue. In crisis mode, which is the case when kinked reserves demand crosses the vertical section of kinked reserve supply, the Fed can simply issue a dictate where interest on reserves and the discount rate are higher. Those dictates shift reserve supply and reserves demand upward. This does not affect quantity of reserves in the banking system. Because it does not affect the quantity of reserves in the banking system, the quantity of money in the market for money is unchanged. If the Fed wishes to reverse the previous increase in interest rates, it can shift the reserves demand and supply downward by again simply issuing an edict that says interest on reserves and the discount rate are now lower, which again does not affect the quantity of reserves. For that reason, the quantity of money in the market for money is unchanged. In crisis mode, the Fed can buy bonds from banks without affecting changes to the federal funds rate. Or it can sell bonds to banks without affecting changes to the federal funds rate. When the quantity of reserves changes, given a value for the money multiplier, the quantity of money in the market for money changes. which would affect the nominal rate of interest.